Ladies and gentlemen, we'll be commencing in about 10 minutes' time, so if anyone needs another quick beer or something like that before they run back up the stairs, now's the time. Welcome, ladies and gentlemen. Thank you for taking the time out of your night to come and have a listen to some of the most astute speakers on real estate subject in Australia, in particular Dr. Di, Dr. Asti, and you'll be intrigued by all of her knowledge and things that she's got to speak about shortly. We are live streaming this for a few people that weren't able to come along. There's a couple other things going on for people, obviously. Just waiting for the last of them to wander in and stop their noise. There you go. My name's Simon Fremantle. I'm the principal of PRD Real Estate in Wagga. We've gone to a bit of effort, or a lot of our staff have gone to a lot of effort. I haven't done a hell of a lot, but here we are tonight to present to you the state of the economy and the Wagga market update. Just a little bit of housekeeping. The coffee and tea is over here at the front. Beers are downstairs. I see most people that need them have found them. Toilets are also downstairs for any of those that need them. And you will have received a little book. So in the little book, if you open it up, you'll see a number of the speakers, but you'll also see a QR code in the top left-hand corner. That QR code, you can scan that and send questions through that you might have for anybody that, and they'll come through to the phone. They'll be able to answer those for you as best we can. There is also a bit of a lucky door prize and a few other bits and pieces which we'll run through for you later on. On the back of the booklet, there's a QR code there, which after the presentation, that will be all of the information from the presentation will be uploaded to that so that you can run back over through it, etc. So you don't have to burn yourself out taking too many notes. Just like to welcome our first speaker, Dr. Asti. As Chief Economist for the PRD Real Estate Group, Dr. Diaswati, which is Asti, leads a nationwide Australian research team providing high quality property, housing and market research to the PRD franchises, and brings a multitude of expertise, economics, public policy, demographics, housing data, future projects and supply of housing, stakeholder engagement and management and a high level data analysis. Asti holds a PhD from the Faculty of Law at QUT, Queensland University of Technology, specialising in public asset management and governance. Asti is the industry co-lecturer and research supervisor for QUT's Bachelor of Property Economics within the School of Economics and Finance, Faculty of the Business and Law. She was previously an industry partner with the Australian Federal Government's Australian Research Council linkage on sustainable housing. Asti was appointed by the Queensland State Government to the Brisbane 2032 Olympic and Paralympic Games Legacy Committee since 2022 as a housing economic specialist. Asti is a member of the Residential Committee of the 2023-24 for the Property Council of Australia for the second term and a member of the Reserve Bank of Australia's Liaison Program. Asti is awarded the prestigious Migrant Leader of the Year Award and the Woman Changing the World Awards 2024. That's a new one. Congratulations.
Thank you.
Asti has provided expert property and real estate commentary at national and international seminars as well as various print, online, radio and TV media. So without listening to me for any longer than you need to, I'm going to hand it straight over.
Thank you. That's you, and that's me.
So it's amazing what technology can do.
Yep. You press the middle button.
Oh, sorry.
That's right. You have it up already.
Hello, everyone, and good evening. Thank you, Simon, for the amazing introduction and for actually reading out my whole bio. I was not expecting that. So thank you for that. Hi, everyone who is in Facebook, who is probably tuning live right now. I'm so sorry that you can't be here with us. And for everyone who is here this evening, thank you so much for being here. Once the slides load up, we'll start off. But for those of you who don't know me, my name is Dr. Asti Mariasmo. I am I live in Brisbane. So it's actually been quite an interesting day because I flew to Sydney at 6 a.m. today and then on to Albury and then did this similar presentation in Albury, and it was actually in a gold class cinema. And so the whole cinema was booked out and we had the slides up and everybody in comfy chairs and things like that. And then drove here, and now I'm here with you guys in Wagga Wagga, which is absolutely just amazing. And then tomorrow I'll be in Canberra and then in Bungendore, if any of you would like to catch me in Canberra or in Bungendore for a second time round. Okay, so today what I would like to give to you tonight, very, very high level, because again, I think I only have 45 minutes, Simon, about that time. Yeah, about 45 minutes, just to walk you through a little bit of some stats on what is happening in the economy, what is going on in the market. And a lot of people ask me all the time, what's going to happen to housing? What's going to happen to the cash rate? Are we actually going to see a cash rate cut anytime soon? What is the RBA thinking? What is happening? And I get that question literally every day, whether I'm in a setting like this or if I'm in a meeting, if I'm with government, if I'm with landlords, if I'm with developers, or even just in general settings, if I'm having drinks, dinner, at a barbecue, at an event, all of those sorts of things. So for those of you who don't know PRD, and let's hope that I don't press the wrong buttons like last year and start the whole video. For those of you who don't know PRD, we have offices all across the country. So as I said today, I've been a little bit all over New South Wales and then ACT tomorrow. And then I'll be in Victoria towards the end of the year. And earlier I was in Queensland, and then I think I'll be in Hobart in November. So what we do is we provide the in-house research data for every single member in the PRD network, which means that when I give you the cues, any graphs or any data that you see tonight can be replicated in any of the areas that you are interested in. So tonight's data is specifically for the Wagga Wagga local government area, so it's the whole local council. But that doesn't mean that we don't have data at a suburb level or at a postcode level or any suburb across Australia. So I'll be queuing you up and saying this particular slide, if you are interested in the data, not for Wagga local council, but maybe a particular suburb in Wagga or a particular postcode in Wagga, or maybe if you do have a friend or a relative or anyone in your network who would like the same information, but say for the Gold Coast or for Hobart or for Brisbane or for Broome or Perth or Bendigo or anywhere in Australia, then we would be able to replicate the same kind of information, but for that local market. So Freo have given you a little bit of a taste as to what I do on a day-to-day basis when I'm not the chief economist for PRD. I also hold quite a lot of other positions, whether it be as an academic, as a lecturer for QUT, for the Queensland State Government's Brisbane 2032 Olympics legacy, part of the Property Council of Australia's residential committee, and what that means is that we are able to see a lot of housing plans and housing strategies that local councils across Australia would like to do, and we give them feedback on that. We do work with a lot of developers. So we've worked with Stocklands, Lendlease and GPT Group, as well as a few other boutique property developers, just to give them a bit of an advice on whether or not the apartments, the houses, the townhouses that they are wanting to build is actually feasible, and if there is a market for the type of product that they're looking for. The one that I think a lot of people are really interested in is our relationship with the RBA. So I sit in their liaison group, which means that every 3 months or so, I provide the RBA with an update on what is happening on the ground, what our PRD agents are seeing, what our buyers and landlords and investors and everyone in the property world is telling me, whether or not people feel comfortable with the way that the economy is going, what sort of concerns that they have, what sort of questions that they have. And it does become quite a long discussion with the RBA. And in return, then they invite us before they release any of their policies, so whether it's on cash rate or anything else, and let us a little bit in on this is what they're thinking, this is what they're seeing, and this is where they want to take the economy. So you'll see a little bit of this in some of the slides, because I've just came back from a meeting with the RBA a couple of weeks ago, where they basically shared, this is what we're seeing, this is what we're thinking, this is where we want to take the economy. And a research team at PRD, funny story, they're all actually my students. They're kind of like the best of the best when it comes to Bachelor of Property Economics. And today, like I said, what I'd like to do is give you a little bit of an overview on a national level of what the RBA is seeing, thinking, feeling, wanting to do in the economy. We'll have a look at how house prices compare across the country. So not just in Wagga, not just in Sydney, not just in New South Wales, but across the country. And then drilling in a little bit more on what we might see in New South Wales and then the local Wagga market, before going back up again into what are some of the other trends that we're seeing across the world, and answering that final question of, are we actually going to see a cash rate cut sometime this year? So starting off on where we are right now in terms of state of the economy, this particular graph is actually very, very telling. These are the two graphs that the RBA likes to kind of figure out or think about and picture where the economy is currently happening or is currently sitting at. Can I, guys at the back, can I point this? Does it actually give me a pointer thing or no? No? Okay, cool. That's all right. Okay, so a couple of things about this one, so that means I'm the one who's going to be traveling, is that at the moment what the RBA is seeing is that most of loans, whether it's your normal 20% deposit loan or whether it's a first home buyer loan, only about 2 to 5% of it is actually at risk. And when we say at risk, we mean that people can't pay their mortgage. So for the RBA to see that it's only 2 to 5%, it's actually still quite low for them. It's not a worrisome sort of state of the market. However, us economists, we call it a surviving economy, not a thriving economy, when the ability to pay mortgages is at the cost of our household savings, and at a very, very large cost. Because when we came out of COVID, we had a big, massive spike in our household savings. And that's simply because during the time of COVID, we couldn't travel, we couldn't go to restaurants, we couldn't hold big bash and parties and things like that. And most people put away their savings. So we had a big, massive spike in savings post-COVID. And as the cash rate increased, people are starting to access their savings, compound that with higher cost of living, higher energy bills, higher petrol prices, more increases in mortgage payments, more increases in grocery bill, up to the part where our household saving has dropped down so low, even before COVID. So our household savings is at the moment around 2 to 3%, whereas normally we sit at about 5 to 8%, right? So our household savings is literally at its lowest at the moment. And so as an economist, we call this a surviving economy because yes, people are able to pay their mortgages, they're able to prioritize their mortgages, but it is at the cost of your household savings. And we did give that feedback to the RBA. And when we gave that feedback, they then replied saying that's one of the reasons why their cash rate has been maintained stable since November 2023, so that hopefully with it being stable, we can start to see a recovery in the household savings. But unfortunately, when it comes to household savings and cost of living, even though mortgages is the biggest part or rental is the biggest part, it's not the only part. Right? You've got groceries, you've got energy bills, you've got water bills, you've got your rates, you've got every other bill in the world that you can think of. So at the moment, what the RBA is seeing, and this is how they kind of test the economy, this is how they kind of make their decision on whether or not to increase cash rates and things like that, is if they are seeing an increase in the mortgage offset account. So when COVID happened, we saw this big, massive increase in people's mortgage offset account. Again, you can't travel, you can't eat out, you can't have a party, so a lot of people put their money away into their mortgage offset account. Now, that did go down because everyone was trying to pay off their mortgages at a higher rate. Right now, though, because of the stable cash rate, many more are actually able to go back and put more money into their mortgage offset. So that's why it's like a V, where we saw that decline because of the cash rate hikes, and then we're starting to see a recovery in the mortgage offset when the cash rate remains stable. So for them, this is a great test to see whether or not something that they're doing is actually working. And this is where they want to see the economy right now. Because if anything else happens, and you'll see this in one of the later slides, if our inflation rate gets to about 4 and above, that's going to be the stress point for them to start thinking about increasing the cash rate again. At the moment, we're at 3.6, so we're not quite there yet. But if it gets to that 4%, that's a higher potential for them to actually increase the cash rate. And they can kind of feel a little bit comfortable knowing that at least at the moment we've had this recovery in the mortgage offset, that there is a little bit of a buffer here if the cash rate hike needs to happen. But again, it is at the cost of people's savings, which is why we've got this other graph that pretty much tells you whether you're an owner outright, whether you're an owner with a mortgage, or whether you are a renter, that people's spending have declined quite significantly. And when people's spending have declined quite significantly, it has a multiplier effect on the economy, because it means that people are spending less on, say, takeout, or spending less on, say, going to the nail salon, or buying a toy, or buying anything else that is not their mortgage. And of course, that means that that particular small business or that particular retailer then lose the sale, right? And then if they lose sales, and if it's too much of losing the sale, then it has the implication where that business might have to close down, or the employees then have to lose a job. So that's why we call this a surviving economy. It's a very tight balance at the moment between being able to afford the mortgages as well as the cost of living. So, where are we in terms of how we're all feeling? This is actually a favorite graph of mine because it tells us whether or not we feel okay as consumers. It's called the Australian Consumer Sentiment Graph, or consumer confidence. And basically, we had this massive increase in confidence post-COVID because we're all happy, we can all go out again, we can all see our friends, we can all have a meal, everyone's feeling good, right? And we've all had an increase in our household savings, we have extra money, now we can go to Bali. I mean, I did, but not everyone did, but anyway. But everyone is feeling a little bit happy. And then the cash rate hikes happen. And so then everyone started to go, oh, not so good, cost of living, etc., etc. And the consumer confidence dropped down, quite low. Anything under 100, so 100 is like your base positive index point. Anything under 100 means that most people tend to save as opposed to spend. So it also means that people are not as confident and they're a little bit more cautious. And right now we're at 85.0 index point. There is a slight recovery here that you can see when it comes to consumer confidence, but it is very, very, very slow recovery. So how does that translate to the real estate market? It translates to what we call sticky buyers. And what that means are buyers that are just a little bit hesitant. They want to make sure that because they are committing to a higher level of debt and that they are going to have to service it with a higher interest rate, that they are getting the best value for their money, that they are getting the best bang for their buck, so to speak. And so what we're seeing in the real estate market, whether it's in Wagga, whether it's in other parts of New South Wales or Victoria or Brisbane, Sydney, Melbourne, anywhere, is that we're seeing the average days on market starting to increase. So we're seeing houses that used to sell in a week or 2 weeks starting to become 4 or 5 or 6 weeks. The demand is starting to get sticky. And when we say sticky, we don't mean that the demand is not there. We're still getting 30, 40, 20 people to open homes on a Saturday. But in terms of actually translating that into a signed contract, that's the part that it becomes sticky. That's the part where we're seeing that there's a bit of a slowdown and that days on market have increased a little bit. Thank you. Yay. I don't have to travel around so much now. That's so good. Okay, so as I promised, what is happening in house prices across the country? As we can see here, pretty much everyone is in recovery except for Melbourne. So nationally, we all had this big, massive growth when it comes to house prices post-COVID. Cash rate hikes happened, went down a little bit, and then it literally just bounced right back up. And the reason why it did bounce back up is because of the stable cash rate, but then also because we really do not have enough supply for the demand. We just do not have enough houses. We don't have enough apartments. And we have had a massive spike in terms of international people coming back into Australia. As you can see, whether it's regional areas, whether it's Sydney, whether it's Melbourne, whether it's Perth, whether it's Brisbane, whether it's Adelaide, we're seeing a massive recovery in house prices. The only one that is seeing a slight tapering is actually Melbourne. And the reason for that is that a lot of people in Melbourne are still a little bit more cautious in terms of their economy, in terms of what's happening in Melbourne at the moment. There is a lot more people going back into Melbourne, so their level of demand and population growth have recovered. And that's why we're seeing a bit of tapering there in terms of Melbourne. The one thing that I will say though is, well, two things actually. The first one is that the RBA did not expect this sudden V shape to happen. They thought that it's going to be a little bit more of a U. And when I say a U, it means that they thought that we would stay here for a little bit longer, right? They thought that the prices will stabilize for a little bit, it'll go down a little bit longer, and we will stay there. So that's what they thought. But we did not. We actually recovered really, really quickly because of the undersupply in housing. Now, another thing that I can say is that because we monitor the residential data, not just for Australia, but for a lot of different countries, and you'll see this towards the end of the slides, is that Australia is one of the very few countries that has recovered so nicely and so much since cash rate hikes happened. So across the world, a lot of other countries also did cash rate hikes, whether it's the US, whether it's UK, Canada, New Zealand, all of them did cash rate hikes, right? And all of them also experienced a decline in median house prices. But not all of them have recovered when it comes to house prices. We're one of the very few economies across the world that has. So what does that mean? It means that international investors look at us and say, that's actually a really good place to invest. That is actually a really resilient economy to invest. And not only that, even though we are getting more expensive, as you can see in this graph, we're getting more expensive, our house prices actually sit in the middle when it comes to worldwide comparison. So places like New Zealand, the US, Canada, South Korea, Hong Kong, Singapore, Beijing, they all still have a higher median house price than us. We are a little bit more expensive compared to, say, the UK, only very slightly. A little bit more expensive compared to France, compared to South Africa, compared to South America. But we do have a lot of other countries that consider us to be more affordable, right? And so it's almost like a double, triple threat, you know? They see that we're more affordable than their home country. They see that our economy is more resilient, and they see a bigger capital growth in Australia compared to their country, which is why international investor viewing have pretty much increased by 240% in the last 6 months on realestate.com.au. It's because they're all looking into our property market. The good news, though, is that international investors can only access new products. So they can't access the home down the road from you that has been lived in for the past 15 months. They can only buy new products. So new houses, new townhouses, new apartments, that's the only thing that they can access. So there's a bit of a saving grace there when it comes to what they can access in our market. We all know that there's a rental crisis. We all know that rents have been really, really high. It's traveled really high. The RBA sees this as well. They have seen a slight decline in advertised rents. I actually gave them a critique when it came to this particular graph. I said, don't use advertised rents, because advertised rents does not mean that it is the final rent. It could be that a house is advertised for $350, but then there's people who put up their hand and say, I can afford $380, I can afford $400, I can afford $420, and that becomes the final rental price, right? So I actually critiqued them on this, and I actually said, that's all well and good, but it doesn't actually tell us what is the final price. And more often than not, that is what the people need, as opposed to advertised rent. But still, we still have this pattern of rental market still going up and up and up, basically. I just did something. No, what did I do? Damn it. Help. It came back. There was a slide that was empty, thank goodness. So the other thing that I love about giving all of this data is kind of that future crystal balling sort of thing, because a lot of people ask me, how long is this market recovery going to go for? How long is the increase in prices going to go for? Are we going to get a bit of a break? And unfortunately, the answer at the moment is no. There is a very small chance of a break. And the reason why there is a very small chance of a break is because of this. So if we look at the New South Wales population change, we have basically increased quite a bit. Even though they're slightly up and down there, as an overall, it's an increasing pattern, right? There's more and more people choosing to live in New South Wales. When it comes to construction, which is this grey one, yes, there are some parts where construction might have gone up slightly, but as an overall, it's been going down. There's still a declining in construction. So at the moment, we have this big gap. Hang on, I'm just trying to figure this out. We have this big gap between where the population growth is and where the construction is. So we have this very big gap here right now. But not only that, we're still trying to make up for the gaps that we see here and the gaps that we see here. Right? So it's not just about this current gap, it's also about trying to backfill all of these gaps that we're seeing in population growth and residential construction. And so in terms of crystal balling on how far or how much longer is the increase in prices, the answer is that at the moment, it is still on that growth trajectory. It is still definitely on that path of recovery. One of the other things that I like to say about this is another graph, one of those graphs that can be changed and replicated because we have the data for every single state. So if anyone is interested not just in the New South Wales data, but also say in Queensland, Victoria, WA, etc., we can pretty much create the same graph, but for that particular state. So if anyone's interested in that, then obviously just please let me know. So moving on to the current trends in Wagga. Do you like my holding slide, Freo? It looks beautiful, doesn't it? Yeah, when I first saw it, I thought, oh, I want to live here now. That just looks so pretty. We don't get this in Brisbane, guys. That looks way prettier. So in terms of Wagga, again, please remember that this is for the whole of Wagga Council, so the whole local government area. And this is the start of, remember the slides where I said that we can replicate it for any place across Australia? This is where the slides start. So any slides that you see or any data that you see from here on is something that we can replicate in any suburb across Australia if you so wish. So where are we at in terms of Wagga and growth and things like that? I'm one of those people who always like to see trends and like the lines as opposed to the actual dollar figures. And the reason for that is because when it comes to house prices, it can change quite quickly. That particular house price that is currently there, it might change in the next 2 weeks if Freo decides to sell 10 more houses. Right? Or it can change in the next month if everyone in Wagga is doing amazingly well in terms of real estate and we have another 30 sales. So I always like to look more on the line. And in terms of Wagga, we definitely saw a big increase after COVID. The best thing is that we are still seeing an increase, even though it is slightly slower in the past 12 months after the cash rate hike, which is absolutely amazing. It is a more premium market compared to, say, Snowy Valley or Greater Hume. It is a more affordable market than Greater Sydney. Greater Sydney is at 1.3 at the moment. So what is that? Is that triple almost? Yeah, it's almost triple. And the best thing that I do like though is I always love seeing the longitudinal or like the 10-year growth. So not just the 1 year, because things happen in a year, right? You've got elections, you've got new politicians coming in saying this, that, and the other. You have different things happening. The cash rate might happen. All sorts of things happen in a 12-year period. But when you kind of look at it from a long-term 10 years, it gives you a little bit more a sense of this is how the market has performed from a longer period. And we can see that Wagga has definitely performed much better actually in terms of your 10-year growth. What's that number? 86? Actually better than Greater Sydney. And that really shows the potential of Wagga in terms of that place to invest in terms of capital growth. That yes, even though there is a slightly slower market in the past 12 months compared to Greater Sydney, it actually has a higher growth rate over the past 10 years than Greater Sydney. And of course, it's a more affordable market. Oh, nope, wrong one. This one. So breaking it a little bit more into houses, units, and vacant land, like I said, again, definitely we are seeing that increase in price, even though or can you do it for this postcode? Or can you my friend really wants to know, my best friend in Wagga might be thinking about investing in the Gold Coast. Can you please create this graph for the Gold Coast, right? So if anyone is interested in that, then please let Frio and the team know, and we'll be able to create one for you. So I love this particular pie chart because it kind of shows where or how the market has moved. And Wagga is definitely moving towards a more premium market, because back in 2021, only about 14% of house sales were 700 and above. So that's your premium pricing. If we use that same legend, and that's why we've kept it the same always, we have seen that grown from 14% all the way to 30 plus, what's that, 31%, which basically means that the premium market has doubled in Wagga. So we're definitely seeing that shift, and Wagga is not alone. Even though the numbers are slightly different, I saw exactly the same pie charts and the same pattern in Albury. I saw the same exact one in Whitsundays, the same exact one in Mackay. Right? So regardless of which regional markets, I'm seeing the exact same patterns. The numbers are slightly different by 2, 3, 4%, but the pattern is literally always the same. Oops. The same thing is happening also in the unit market. We are definitely seeing less affordable units in the market. So about 44% of units were in that most affordable, so that really big red in 2021. And we can see that that has shrunk quite a bit in 2024. And like most markets in regional areas, the one that has really grown is the mid and upper. So that's your grey part of the pie chart and the darker grey of the pie chart. So that's again because people who can't afford the houses because they've become a little bit more premium, they then move and have a look at units, and they then push up the prices in the unit market. And again, I saw exactly the same thing when I was presenting in Albury earlier. The numbers are slightly different, but exactly the same sort of pattern in terms of the pie charts. So moving on to the rental market, we all know that rents are quite high. We have seen a slight stabilization in rents, and one of the reasons for that is because we've seen more investors come back into the market, which means that if we look at those bars there in terms of the number of houses and units that is available for rent, it's coming up, like it's starting to recover. And when that happens, that's where that stabilization in rentals it actually happens. And we're starting to see that, which is quite some good news for renters. It doesn't mean that it's bad for investors though, because if you look at it from a long sort of like 10-year perspective, we've definitely seen an increase in rentals as well. Okay. I think I'm using this one still. All right, so the one thing that I love about this graph and the next few graphs that you'll see, this is specifically almost for investors, is how we're traveling when it comes to rental yields. So for house rentals, definitely still high, still much better than Sydney, and of course a much more affordable entry price. We have seen it slightly go down in comparison to say about 2 years ago. And the reason for that, like I said, is because we've had more investors in the market, and we have seen a slight tapering in rental yields, in rental prices, but we are still quite high at 4.3% as of June 2024, and that is definitely still higher than Sydney. Unit rents is always slightly more fluctuative, just because the unit rental market is always much smaller than the house rental market. But we are seeing the Wagga unit rentals performing pretty much on par with Sydney, which is really good. And also the fact that we do have a much more affordable entry price for units makes that unit market still very, very attractive for investment. The one thing though, if you are an investor, that you must ask is about vacancy rates. because your rental yield can move up and down depending on what's happening in terms of median house prices, like how much you've paid for that particular house or unit, and the rental that it's going to put in for you. But vacancy rates tell you how quickly your rental property will be rented. And as an investor, I know, because I'm an investor myself, is that I would always like to keep my cash flow going, right? And so if you have a high vacancy rate, so anything 3% and above, because the Real Estate Institute of Australia have put 3% as the healthy mark, anything that is above 3%, it shows that there is more rental properties than there are renters. So your property is going to spend a little bit more time on the market before it gets rented, which may impact your cash flow. So you want it to go as low as possible, as close as possible to zero. And at the moment, Wagga's really tight, so it's at 0.6, which is all the way down there. Definitely much lower than Sydney, even lower than neighbouring Snowy Valley. So that means we are definitely seeing a very tight rental market. And the lower that you go with your vacancy rate, the better, because it means that income cash flow can keep on coming in as fast as it can. Again, another graph that we can recreate to particular postcodes or particular suburb across Wagga. So if you do have a particular area in mind, please feel free to let us know and we can recreate this for you. I love these blanks, by the way. It kind of gives me a break. So thank you for that. Looking into the future of what to expect, one of the things that us at PRD is very blessed on is that we are actually able to see every single project across every single suburb in Australia. So if there's a new KFC in Bendigo, if there's a new subway in Wagga, if there's a new hospital in Mackay, if there's a new aged care in Perth, we're able to see it all. If there's a new bridge in Hobart, I can see it, right? So we're very, very lucky that we can see every single project across the country. So residential projects are pure residential. So that means houses, townhouses, apartments, that's it. Mixed use is if there's two uses. So maybe you've got apartments at the top and retail down the bottom, or you have an office at the top and some retail down the bottom. Infrastructure is anything that is funded by the local council, the state government, or the federal government. So that can be public hospitals, public university, social housing, etc. Industrial is warehouses and logistical, and commercial is anything of commercial nature. So places like this, your bars, your clubs, your hotels, your cinemas, things like that. So we're definitely seeing that in 2024, there's a lot more infrastructure projects that is currently that has a development approval. And then a little bit more on the commercial and infrastructure for 2025. As you can see, the residential, the red has become slightly smaller, which means that it is a concern because it does mean that the undersupply will continue. The one thing that I will say about this particular slide is this is what we call a live or a moving slide, because obviously 2024 has not finished and 2025 has not started. So, and it does get updated pretty much on a monthly basis because new projects get added on, or sometimes projects are abandoned, right? So at the moment, this is how we stand. And at the moment also, in terms of the number of units, townhouses, dwellings, lots, we are for 2024 seeing a little bit of an increase for houses, so 26, a lot more lots, hopefully more houses in 2025. So these are the ones that we know of that has development approval as of June 2024. So again, definitely a much better trajectory when it comes to more houses and more units and apartments coming into the area in 2024 and 2025. But again, we all know that there is construction challenges at the moment. A lot of projects do get abandoned or deferred. And a lot of the times when something has had a DA, it does take an extra 12 months than the kind of scheduled completion date. So what can we expect? Here's the answer to everybody's question on whether or not we're going to see a cash rate cut. Unfortunately, the answer is not yet. And the reason why not yet is because of inflation. So inflation back in February, this inflation graph, the projection was that this inflation graph will just keep on going down. That's it, just a straight down. And if it was just a straight down, back in February, the projection was that there'll be a cash rate cut towards the back end of 2024, right? Second half of 2024. However, that projection has changed. So instead of it just going straight down, it's actually increasing a little bit and it's stabilizing, and there's a little bit of more bumps along the road for inflation before it can actually go down. So basically at the moment, what we're seeing is that because of these small bumps and because it's not a straight downward, it then translates into the cash rate. So if we look at the cash rate here, it then translates into a cash rate that is being held stable, right, for the rest of 2024 and possibly a cash rate cut towards the tail end of, or the beginning of 2025. So if anyone is, because I get it all the time, like, do I wait until the cash rate cut happen? Do I wait until, like the end of 2024 to buy? What do I do? The answer is, when it comes to the cash rate at the moment, the projection is to keep it straight or to keep it stable. There is a possibility of an increase depending on whether or not this increase in inflation actually happens. And if that increase in inflation happens, like I said, their sort of like danger zone is anywhere 4% and above. So if that does happen, then the likelihood of that increase in cash rate happening is much higher. The one thing that we can say about our cash rate though, and that again leads back to that why a lot of international investors are coming here, is we actually have, without many people realizing, one of the cheaper cash rates across the world. So our cash rate at the moment is at 4.35, so above the 4. If we look at New Zealand, they're above 5. If we look at the US, it's above 5. Canada is on the 5 and UK is slightly above 5. So without us knowing, or without us, men don't realize, is that we actually have one of the more cheaper cash rates across the world. So it's almost that triple threat of it's much cheaper to borrow money in Australia. We have a more affordable house price in comparison to a lot of other places around the world. And they've seen how resilient our house market is in terms of rebounding back from the cash rate hike. So that's a triple threat, right? That's kind of like one of the main reasons why a lot of international investors are now looking into Australia. So what are some of the projects that we can see in Wagga between 2023 and 2025? I won't go through every single project here. I know that you'll be able to read this more by yourself because we are going to give the slides out. But we are definitely seeing some more infrastructure and some commercial there. Again, we can replicate this for any suburb, any postcode across Australia. So if you do want to see what other projects are happening in other places, then we can definitely do that as well. The one that I usually am more interested in is this mixed use and residential, because then we can have a little bit of a peek as to where all of the residential projects are about to happen. Most of them are lots, and a lot of the apartments and the townhouses are delivered through a mixed-use product. So I'd like to just touch base a little bit on a new report that we have just released. It's called the Australian Economic and Property Report 2024. We released this, I think, in early August, and it's our newest report, and we call it Different Markets, Different Gears. And the reason why we did this is because of this particular graph. So this particular graph tells you what's happening in regional areas across the country, right? And what we can see is that every single region is doing its own thing. That's why it's different markets, different gears. So we're seeing places like Queensland, it grew and then it's kind of holding stable. What colour is that? Orange. New South Wales is holding a little bit stable. But then we see places like Tasmania, places like Victoria, places like regional Northern Territory actually having a bit of a decline in their prices. And then we're seeing places like regional Western Australia that is still growing. So basically different markets are doing something quite different, right? There are some markets that are holding steady, some markets that are still growing, and then you've still got some of those markets that have actually become a little bit more affordable. So that's why we called this particular report Different Market, Different Gears. Another reason is that because buyers are thinking differently across different regions in Australia. Now this particular graph is going to look like a bowl of pasta. It's pretty much a lot of squiggly lines, and that's why I call it a bowl of pasta. But it basically tells us whether or not buyers or people are thinking about going into the market. And right now, if I draw your attention towards that pointy end here, most buyers, most of all of the states across Australia are seeing this decline in buyer activity, where buyers think that, nope, it's not the time to buy a dwelling at the moment, it's not the time to actually sign that contract. And that's why we've got that sticky buyers of, the average day on market becoming slightly longer. Two places are seeing an increase in buyer activity or people thinking that now's a great time to buy. The first one is that red, which I believe is New South Wales. And then the second one is this big green one, which is Tasmania. Right? So that's another reason why this report is called Different Market, Different Gears, is because we are seeing different things. We are seeing some buyers becoming a little bit more stickier than others. Places like WA, for example, they've become quite sticky, like they're the ones that had the biggest decline in time to buy dwelling index. But then you've also got buyers in Tasmania that is really raring to go and really wanting to get into the market. Last but not least, I will leave you with this particular graph, which is the first time that I saw this, I thought, oh my God, what is this telling me? But this particular graph is actually really interesting. And the reason why I love this graph is because it tells me that we're not alone. So this graph, and one of the beauty about our data is that we don't just have data for Australia, we have data for pretty much every other country around the world, which is why we're able to create graphs like this, is it tells us that our undersupply is not just an us problem. So that's us, the big red one. That's Australia's residential construction. Like I said before, it's on the decline. We have an undersupply issue, but we're not alone. If you look at New Zealand, they're doing this exact same thing. Canada, also on the decline. France, same thing, decline. Green is what? South Korea. South Korea is on the decline as well. Japan, slightly on the decline. The one that is having a massive boom, this grey one, is Hong Kong. What is that one? That's United Kingdom, and then that's United States is also having a slight increase in their residential construction. So this particular graph tells us that we're not alone. We're not alone in our housing supply issue. We're not alone in trying to actually solve the housing supply issue. This particular report is now available. It does tell you what is it went back. I need to go back one more. I don't know if I can. Is it going to load? Okay, do I just wait? One more?
Yep. Sneak peek? Oh,
No. No, go back that way.
Oh, the other way. So,
That way, that way. That's okay. If it doesn't load, it doesn't load. That's all right. Maybe I just have to wait.
visualization column.
No, that's okay. So that particular report is currently available. Yes, this one. So this particular report, the Australia Economic Probability Report, is currently available. It does give you a little bit more of an insight into the property clock, which is whether the market is a peak or still going down or in recovery for every single place across Australia, divided into the capital city, metropolitan or regional area. So I really encourage you to have a look at this particular report. We will be, I believe, you've got a copy, Freo. I know you have. So if you can send it out to everyone. Kelly is giving me the thumbs up. Awesome. That means that everyone who is here will get a copy, which is really good. So we've got that report that has recently come out. We also have, we also have this particular report that might be of interest to you. So this particular report, hopefully I just need to go back one more. This particular report is what we call our roaring regions. So what we've done is we've looked at every single council across Australia. And what we've done is we looked at the prices, we've looked at their capital growth, we've looked at their investment potential, we've looked at what sort of infrastructure development is about to happen in that particular council. And we've nominated certain councils as our councils of choice. And again, we've looked at every single council across the country. So I encourage you to have a look at this as well, in case Wagga might not be the place that you'd like to go, but other places across Australia. And I think that's it for me. Thank you so much, everybody.
Thank you very much, Asti. There's a lot of information to take in there. And as I said, in the book at the back or the front there, you've got the QR codes, so you'll be able to pull up some of the graphs and run over some of the things in your own mind if you need to get some information. Just on some of that infrastructure spend, some of you may be aware of how much is coming to this region, and you may also have some concerns about housing prices. When we've got a 0.6% vacancy factor in Wagga, that's historically low. It's putting a lot of pressure on residential tenants. So whilst it's great for investors, it does put pressure on tenants. With the infrastructure coming to town, that'll put even a significant higher amount of demand on residential tenancies and places as the workers have to come to town to build the bridges, to build the power lines, to build the RAF bases and the Kapuka bases that all form part of that infrastructure project. So Wagga's going to be strong for a very long time to come. So you can basically invest with confidence. One of the other things that did show up a little bit was the small wedge of residential development that's was on those graphs in regards to 2024, 2025 in comparison to the other spends. That's a concern. It's been a concern of mine for a number of years. I've addressed it with council a number of times, and we're still a long way off getting that fixed. So probably watch this space and buy with confidence because it's not getting fixed quickly. So pricing's going to be good in Wagga for a while to come yet. Thank you very much for your patience. Thank you very much, Asti. Very much appreciated. It was very insightful. We're going to break it up a little bit and do the lucky door prize. So anyone that's got a little ticket, we'll get Asti to draw it out for you.
Always been bad at this.
Well, I didn't get a ticket, so you...
Hang on. Before I do this, does everyone have a ticket?
No, I don't.
You don't count. We're not eligible. Everybody has a ticket. It's already being put in here.
Too late.
Okay, cool. Just in case.
They must have snuck in the back door if they don't have one.
I don't want people to. Okay, so it's a green ticket. CO4. Someone has to have it.
There we go.
Yay! There we go.
Well-deserved winners.
Awesome. What do they get? I want to know. Oh, you get a hand pump. Come and see us at the end.
Righto, ladies and gentlemen, we've just got a quick spiel now from a variety of people within the PRD team itself, touching on purchasing, investments, rental markets, commercial markets, and whatever else we may be able to run through. So we'll start with Ryan first, are we?
Thanks guys, really appreciate you making the effort here on a Wednesday night to come down to the PRD Investor Night. We're really lucky, I suppose, working within the organisation that we do get to see Dr. Asti and a lot of the information that comes out. I know there's a lot of people out here in the crowd that I see very regularly on a Saturday open home and throughout the week as well. All that information is available if you ask any of our sales agents on the ground. So if you're there in an open or you want to shoot us a message or send us an email, we can get you that information, and we've already read a lot of that stuff, especially that's hyper-local to the Wagga Wagga area. From an investment point of view though, when we're selling on the ground, we really look at a lot of this stuff. So as a team, we go through every property that's listed through our agency as well, with all those sales agents. And then Scotty, who you'll hear from in a second, who heads up our property management department, also sees those properties. What that forms is that connection between property management and sales to find out what that rental return is. So as Asti said before, our rental vacancy rate is about 0.6 at the moment, which is incredibly tight. So anyone who's a tenant at the moment, or you're looking to go and rent a house, it is competitive to get there. And we see that from a sales point of view. So whilst I'd love to have 20 to 25 people through an open house in Wagga, the reality is we're probably more about 3 to 4 people through an open house, with a mixture of owner-occupiers, with a mixture of neighbours, with a mixture of investors as well. But the people who are coming through from an investment point of view, we are talking to them very thoroughly about the opportunities to become an investor with the residential market, because the vacancy rates are so low. We're very, very confident with the product that is selling, if you're purchasing homes, that it's going to be filled by a good quality tenant, and it's going to give you a cash injection over the years in capital growth as well, because they're paying that weekly rent. We know what the return's going to be because Scott's normally given us that letter, so we can actually tell you that with confidence. And if you want more statistics and information into that as well, it'll be there. The other one, if you're shopping and you're coming through on weekends and that, asking any of our sales team from that point of view, we can pretty much guide you with a different product differentiation if you're looking at renting or looking at other products to purchase. Not all houses are great investments, and that's just a simple fact of it. A 20-acre house on a 16-bedroom mansion sometimes isn't going to get you the rental return as something that's in a really good high-quality location that could be a freehold or a strata title or something like that. And we look at all those sort of different combinations from a sales point of view to form obviously the sales price, but to get you guys the return back out of it. And vice versa, if you're currently holding an investment property as well, and you ever want to chat to any of the guys there, there's about 12 incredibly highly skilled real estate agents working within the PRD group in here in Wagga Wagga. They can give you the information that's coming back out of it. If you're looking at selling, or you're maybe wanting to talk about renting it out as well, we can guide you in both those sort of avenues as well to give you that quality of information to make a very, very important decision from yourself. So that's sort of sometimes the first steps when you're hunting either to buy or rent out as well. And we'll normally also get the property management guys involved in that point of view. But as I said, if you ever see one of our signs up, even for one of the open homes, and you're sitting around the corner and it's your neighbour, come in and say hello to us and have a chat to us as well, because we can really give you some of that information, whether that's going to be for 6 months away, 2 years away, 5 years away from that point. But from a rental point of view, from the stance at the moment, and Asti's touched on that, whilst interest rates are still high, we've really transitioned to a very balanced market where there's very good value for buyers, but there's also very good value for sellers. So it's not sort of the seller's market that it was 2 years ago, that prices were skyrocketing. We really have plateaued back to where we were about 5 years ago is where that market sits. But from an investment point of view, the investors are still doing very, very strongly in their cash return from that point. Their capital return though, if you're looking at selling with a tenant in place, is a very, very different scenario to selling a vacant property as well. And they're all the things that we guide you through to give you guys that quality of information there from that point. But that's probably about me from a sales point of view. If you send a message on the QR while we're up here, we'll get it, so we can definitely answer any of those questions for you as well. But I'll pass it over to Anthony from our commercial team.
Thanks, Ryan. So Anthony Paul's my name. I run the commercial team at PRD in Wagga. Our commercial team comprises Simon Azzopardi, who's up the back of the room, and Lisa Ryan, as well as Tom and Liam, who is our marketing arm of the commercial side, and of course the accounts department. Just to give you a little bit of a brief insight, we currently look after we manage 301 commercial, industrial, retail properties in Wagga, and that's increasing as Wagga gets busier itself. In the past 6 weeks, our commercial team, which was myself and Simon, have sold 9 properties, and they are at Blackson Road, a couple in Baylor Street, Fitzmaurice Street, 2 industrial units in Hammond Avenue, a property in Cootamundra, a property in Thompson Street, Nagle Street, and in fact 2 of those properties were sold on the first day they hit the market. Commercial properties in Wagga, people are still looking for a return of about 7% net, which of course, as you saw from the graphs that Asti had, is a little bit higher than the residential side of things. So the commercial, owning a commercial property does give you a good return. Vacancy rates are quite good in Wagga. Any property, of course, that is fully leased up is fairly tightly held by owners. And when they do come on the market, they are sold very quickly. What's happening commercial and industrial in Wagga? Our big problem is going to be industrial land. So those that want to build their own shed for themselves, those that want to build their shed to rent out, they're struggling to find land in Wagga. And it's going to be a problem that's going to continue on. We've got 3 industrial areas. We've got West Wagga, out Dobney Avenue, Pearson Street. You've got East Wagga, which is your Copland Street heading out towards the airport. And then you've got the Bowman area out there, which of course has the new Bowman hub, which I'll address very shortly. In relation to industrial land, we've got a couple of owners in Copland Street in the East Wagga area who have some land out there, and if I can talk them into subdividing, which we're still trying to do, we'll have about 40 blocks of land. And of course, if they start putting plans into council today, it'll be 2 years at least before those blocks come on the market. So at the present time, you'll struggle to find a smaller industrial block to build on, to the point there basically is none at the moment. So we're hoping we get some more land in Copland Street, which I say will only be about 40 blocks. After that, the council doesn't have any plans for any more industrial land in the East Wagga area. West Wagga is landlocked. We've then got to go to Bowman. And at the moment, I'm not sure if a lot of you have read the paper about the Bowman hub, the rail hub out there. The councils and the state government and federal government have spent a lot of money developing that project out there. There are 11 lots on the rail hub itself, 14 lots behind that, and then there'll be a lot more land in years to come flowing back up to the Olympic Highway. The problem with the land at Bowman is, in the present industrial estate, which has been there for many years, there is basically no land for sale or available. Council have 2 blocks of land out there which are probably 30-odd thousand square metres in size. And then the rail hub, the difficulty with that is it starts at 20,000 square metres and goes up to 40,000 square metres. So the problem we're going to have, and what we presently have and will continue to have, is that the blocks of land, 3,000 to 4,000, 5,000 square metres, there's just none available. So that's a little problem, and that of course will create demand for those sheds that are out there built. There's not a lot vacant at the moment, but those ones that are built, they will become in high demand. Looking at the retail area, which I'm talking about the CBD of Wagga, which is your main street, Blake Street, Peter Street, Forsyth Street, that area there. We've still got our little hubs, of course, at Coringal and South City. But the Wagga City Council is trying to encourage shop-top housing in Wagga. So that's where you have commercial downstairs and residential upstairs. And it's exciting that there are 3 projects now approved. You've got the Home Hotel, which has only just recently been approved. It'll have commercial on the ground floor, and I think it's about 16 apartments above the commercial area. And I think that development was 15.7 million. We've got 115 Fitzmaurice Street, which where the old gallery used to be. It's going to be 5 stories, commercial ground floor, and then units above. And these projects will be starting in the near future. I know the one at 115 Fitzmaurice, he wants to have that building demolished by Christmas. And I know the Home Hotel, the group doing that, are keen to have that start as soon as possible. And then you've got another 6-storey complex in Blake Street, so which will have commercial downstairs, down on the ground floor, and residential above it. And that's exciting for the CBD because it takes Wagga to a different level. All of a sudden you've got these mini high-rises in our CBD, which encourages more people to live down here, keeps the CBD vibrant. So it's exciting for Wagga that these projects are on the move and about to happen. PRD commercial team have a couple of exciting projects about to start that we'll be involved in. We're not the developers, we're only the agents selling them, but we've got a complex up in Fernley Road, and it's has 21 industrial units, raising size from 82 square metres up to 188 square metres. So those units hopefully will start in the next couple of months. It will probably take about 6 to 8 months to build. Whilst they're being built, we'll be selling them and or leasing them, and then we'll sell them on to investors. So if you're looking for a good industrial unit in a varying size ranges, give us a ring. And there's another one at 200 Hammond Avenue, which is 22 units, and it's got a size range of 76 square metres up to 210 square metres. So there'll be some exciting projects coming along, and we hope to have those underway the next couple of months and finished. Looking at the last 2 projects that were done on a similar basis out in Houtman Street, they sold, the first set sold over a couple of months. The second building sold in 1 week. A couple fell over and we had to resell them then. So there's a couple of exciting projects coming forward. If you'd like to be on our investor list and receive information on commercial properties as they hit the market, just contact myself, Simon or Lisa, and we'll put you on that list. Yeah, so that's probably about it for me. There is another property that I just suddenly remembered, which will probably hit the market on Friday, which is 13 Forsyth Street. Used to be Paisley Robertson, the accountants, 2-storey commercial premises, and that will, as I say, hit the market. We think on Friday it'll be put up on the website. So that's all from me, and I'll hand over to Scott Jones.
Good evening, ladies and gentlemen. My name's Scott Jones. I'm the Department Manager at PRD. Obviously looking after a fairly large staff portfolio as well. So I've got 15 staff that I'm managing on a day-to-day basis, which is a credit to them because they're all fantastic and professionals at what they do. The difference between PRD, in my experience, is the experience that we offer. The fact that I've got property managers that have been in the room, that are here, that have been in the industry for 30 years, it's a credit to them and a credit to our team of what we can offer. So congratulations to them first and foremost, because I can't do what I can do without them. So just a bit of a brief of what I'm sort of seeing in the market at the moment. Our vacancy rate, as they mentioned, is 0.6, but as of today it's 0.4. So we're seeing a lot of activity as far as the top end's concerned as well. So some of those properties that we've been able to lease and achieve exceptional results are a part of that SAP precinct that has got Bowman attached to it. So some of those government subsidiaries have come to Wagga and are all pretty much cashed up, and we're renting out property relatively quickly with our vacancy rate at 0.4. Some of those records that we've sort of been able to get, and it sort of differs, from month to month, but generally we've seen it now for the last 3 months in a row. We've been able to achieve high rents, as properties that are renting for $1,500 a week, for example, at the mill, which that property sat on the market for 8 days. So there's a lot of activity out there. Some of that activity also then tightens the market and creates better tenants. So a lot of the time you'll see, some stories in the paper of people can't find property, etc., but that also has the effect that I've seen now over the last 5 to 10 years, where, people are putting rent as a main priority because they don't want to have a ledger that has got 2 days rent arrears on it, for example, because that's going to affect them applying in a 12-month period, because that's one of the main critiques that we look at as an agency when we're assessing applications, is that, if there's a rental ledger that has arrears, that, is someone that's just as good that comes up against them that has got none, and that can affect them getting a property and losing it. So, as I've mentioned before, rents are really tight in Wagga, but I think looking forward as to what's going to happen, it's going to get tighter again, because obviously Wagga has got a bit of a transitional trend to it as well. So generally from the November period through until, say, February, January was where the market would peak. So we've seen that, in the last 3 months, probably in that colder period, that the days on market has crept up. Where now we're back into the churn again, spring's out, people are on the move, and we're able to achieve, really good results. So also another thing that's changing, I think, at the moment is, I'm just going to quickly touch on it, is Airbnb situations. So I've had a fair few investors now that have come out of that market and come to me and seen me and said, well, on paper it looks really good. I'm getting a really great return each week and each month or whatever it might be. But ultimately, when they add up all of the costs that are associated with that, gas, electricity, some tenancies that have been, short-term stays, they're leaving lights on, and they're turning around and going, well, when I add it all up over the 12-month period, I'm better off to actually lease the property with an agency, have a solid tenant in there who's paying all the outgoings, and I'm finding that change has come through. With these people that are coming to Wagga, it's not just one area that they're looking to take tenancy up. It's Coringal, it's Central, it's Estella, Baruma, you name it, it's all over the place. And for a 3-bedroom property, for example, in Coringal, to achieve $800 a week, I think is a pretty good return. So we're seeing it out there. If you have any questions or would like to get in contact with me for some more information, I'll be more than happy to help. As I mentioned, I've got an exceptional team, and I think we're the best in Wagga. So thanks very much.
Thanks, Scotty. Q&A. Any questions from the floor, really briefly? Excellent. Everyone's thirsty. I've got a couple more speakers. Ben Roberts from Corpshaw, General Manager from Corpshaw Insurance Broking, is here. He'll be able to run through a couple of things about what's happening in the trends of insurance, as well as some products that he thinks might be of use to investors, etc. So thanks, Ben.
Thanks, Freo. Good evening, everybody. Ben Roberts, Corpshaw Insurance Broking. I will try not make anyone fall asleep. It is insurance, so I'll try and be quick. But you know what? Insurance, I know there's new investors here, existing investors. Everyone needs insurance at the end of the day. This has come about from seeing significant increases. We all pay different insurances, different things, so we've tried to be the forefront of this. Before I get into the nitty-gritties, just about us, we've just gone 10 years. We're the largest privately owned brokerage in Australia. We've just gone 8 years with PRD now, so we partnered with PRD 8 years ago, which has been a really good one for our regional growth. I know that no one does regional like the PRD group. We do 1,500 agents across Australia, so we are big in the real estate space, commercial property, and now landlords. So it's quite diverse what we do. We are a one-stop shop. and yeah, always try and be at the forefront of claims, especially. Twice. There we go. So it is unique what we've done with this insurance. So we understand a lot of people now have your Terry Shew and EBM for your general landlord insurance, and then I know we've got some from Westpac here, and then you've got the Westpac that do the building. We're trying to get it for not only claims perspective but price-wise, trying to get it locked together. So when we designed this policy here, we knew that cover was important and obviously price was important too. So for the guys that know the insurance part of it, never had to lodge a claim. We've done some nil excesses for a number of the coverages. The big one I like is the nil excess for tenant damage. So you get to an end of a rental property or someone's done a runner and they've trashed the property, you don't pay an excess. So that's, and you've got the 20 weeks for loss of rent, and also a big one we're seeing now is the drug damage. No matter how well the property manager picks out the right tenant, you never know what can happen in a property, being malicious damage, drug, even pet damage is covered too. So really have tried to leave no grey areas of claim. We always want to make sure we get those claims done. But the biggest point of difference is the price for this one. You can see here we've done a table in some of the states we started to pump in. We've also done a local area here. How do I pronounce that one for you? There we go. I'm from Sydney, just so if you didn't know by the way I'm dressed properly. So you can see there the price-wise it stacks up. It does stack up. And you can look at if you've got properties anywhere else, but the price it stacks up. And the reason we have been able to get the rates where they are is our new sensor product we've been able to do. So I don't know if anyone knows about Honey. So Honey have come out, and for homeowners they give you sensors to put in your property. So now we've partnered with Sensor to do it in investment properties. So the big driver of claims and why we're increasing the rates is water damage. So water damage itself, so if someone leaves a tap on or a dishwasher leaks or anything like that, that's where all the claims are coming from. So when you take out building and landlord insurance with us, you actually get a sensor product that goes under the sink, basin, bathroom, and you install there, and that sets off an alarm that triggers a property manager so someone can come and get a plumber out and turn off the tap. The money we're going to be able to save from this from a payout perspective is going to be huge. So the premiums are discounted heavily now, but once you jump on this, our goal is just to get it lower and lower and lower, which, when's the last time anything's done that recently? So that's the forefront of it. It also does cover the cost for your smoke alarms. So if you're paying $99 now with whoever it may be on behalf of the agent, this does include the cost of that. So you save the $99 from doing that, and then you also get all the sensor products included when you do building and landlord insurance. So it's a brand new design. This is actually the first presentation we've come out and done about it. So that's the forefront of it. It is insurance. And I guess from a claims perspective, Freo, if you've been through, that's exactly what we're here to do, but also try and deliver a market-leading policy. Any questions? Any insurance questions? Do you cover Airbnbs? We do cover Airbnbs, absolutely. Yep, we do those. Yep, sure do. And for anyone that has a unit, so we do a set rate for landlord-only policies. So if it's strata or shop or anything like that, it's about $400 for landlord-only. I think EBM's about $450, Terry Shear $5. So it is sharp for landlord-only. But the big benefit you see when you're able to combine both building and landlord, we on average about 30% cheaper than the market on our studies we've done. So, and we do, if someone's got multiple investment properties, we do discounts as well. Any other questions? No one fell asleep, I think. That's good. Very good. Hand it back to you, Freo. Thank you.
Thanks, Benny. After being a customer of Ben's for a number of years now, and we've had a number of properties that have had claims on them, the claim process through those guys has been exceptional, and I'd highly recommend them. Righto, last but not least, Kel, you coming for a bit of a chat with Ryan? From Westpac, running you through their take on where the market's at and how much money they want to give away for free.
Oh, thanks.
Thanks, Simon. Good evening all. I'm Kelly. I'm a mobile home finance manager with Westpac here in Wagga. Thank you, Simon, and the whole PRD team for having Ryan and I here tonight. And thank you, Dr. Asti, for your very informative talk. I've got a notepad full of stats that I'm going to take back to my lending team tomorrow and share with them. So thank you for that. So we've had some awesome information here tonight, and Ryan and I will hang around a little bit afterwards if anyone has any questions. We also have business cards, and if you don't catch me, there's a little flyer where you can put your information on and just hand it to me, and I can follow you up with a call or email as well. So we're in a very complex lending environment at the moment, with things changing on a monthly basis, including Westpac's lending policy. So this is a tricky time for us lenders, keeping up with our changing policy, but even more so for our customers, which is why it's more important than ever to have a very trusted lending specialist to call on. So the lending criteria changes so often. For example, tax cuts, which increase borrowing capacity, but then changes in living expenses, which has the adverse effect. So it's important to keep in touch with your lending specialist when looking for your ideal investment property, just to make sure you still meet the criteria because it's changing so often. So Westpac's goal is to become the #1 bank for investors, and over the past 12 months, Westpac has made it even more simpler and easier for investors to borrow more. So we've made some changes to our negative gearing policy, making it easier for us to apply the negative gearing, which in turn increases our investors' borrowing capacity. We've made major changes to our rental income policy, and one of those changes was we used to only be able to utilise 80% of that rental income. We've now increased that to 90%, which of course in turn again increases your borrowing capacity. We've also made big changes to our self-employed policy, making ours best in market. We've made these changes because Westpac realises that a lot of our investors are self-employed. Some of those changes that we've made, we now take 100% of depreciation without any other requirements. And we used to have to take 2 years of your tax returns and average the two if the most recent year was better, but now we are resting just on the better most recent year. So that increases your borrowing capacity as well, because we don't have to average it out anymore. So we want to make the process more seamless for our self-employed applicants. I also wanted to briefly touch on a trend we're seeing, and that is, of course, that a lot of people are reaching out to brokers, and Westpac is very aware of this, and it's why Westpac is investing a lot of money and time into their first-party channel, which is me. And what this means is Westpac is investing heavily into lender capabilities. So in terms of the systems I use to process your applications, we're simplifying our policies and we're training our lenders just to make the process of a home loan or investment loan application more seamless, and it's constantly being improved. So Westpac has provided our home finance managers with the authority to approve home and investment loans ourselves without the intervention of credit managers. So this makes turnaround times a lot quicker, which is one of the advantages of coming direct to Westpac rather than a broker. I can have a loan unconditionally approved same day. Of course, there's always a place for brokers for those out-of-the-box scenarios. However, for those scenarios that do fit Westpac's policy, you'll probably find it's a lot quicker process just to come direct to us. And I have got that authority to approve loans myself, so I can make the process very quick for you. So I've also seen a lot of our investors coming from the East Coast where they perhaps have been priced out of the market there. and are looking more in the regional areas to invest. It'll be interesting to see how that plays out over the coming years. But as I mentioned, I would really love to chat to anyone who has a specific scenario that what they want to run past me or want to chat further or book an appointment. But Westpac is still approving loans, we're still getting deals through, and yeah, we'd love to assist in any way we can.
Thanks, Cal. Thanks, Freo, for the time tonight, and thanks, Asti. Basically, the biggest question we get front of mind at the moment is what are interest rates doing? Asti touched on it quite heavily, obviously, but the market's looking like we will get some type of relief in the short to medium term. Westpac's forecasting some type of cut around February. However, conditions on that is anything's open to change, so obviously take that into consideration when making those investment decisions. When it comes time to investing, you're either going to be dealing with myself or Kel in the event that you don't have all that money underneath your mattress. So I support businesses basically from 500,000 all the way through. Unfortunately, we don't have set policies as in terms of straightforward application processes. It's a very unique process that we deal each individual customer. We've got an individual approach to each of those sectors and each transaction as a standalone. When investing in kind of your commercial space, you're either looking at an owner-investor whereby you've got a business and you're looking to expand or take ownership of that property, or you're looking to obviously buy a property for tenancy purposes and then you're looking to lease it out. Obviously, when it comes down to it, servicing and security are the two primary risks that we need to address. First and foremost, in the servicing department, obviously that comes down to the industry in which the income's generated. Owner-occupied, I'm not going to deal with, say, a chippy versus an accountant in the same manner as I would. It's just not fair on both of the industries. Having said that, if it's a standalone investment opportunity and you're looking for a tenancy, you need to make sure that obviously there's a long-term tenant in there, the strength of the tenant is good, outgoings, obviously interest rates and things like that are taken into consideration. However, we need to make sure that all the outgoings, rental returns and obviously increases are built into that tenancy, and basically just assess that on its own merits. When it comes down to it, I think the best way to do it is make sure that you've got a network of advisors around you. If you're spending the time to do your due diligence into a property, make sure you include your accountant, your solicitor, obviously your real estate agent and your bank manager. Preparation is key when it comes to making sure you're in a position to move on these transactions. To that point, I suppose we've got business cards over here, and if you've got any questions towards the end or now, feel free to throw them up to us.
Any questions? Any questions for anybody that you've thought of that you would like to ask now? All good? I think that's pretty exciting to know that Kelly can now approve home loans and that you can do it within that short period of time. I know that's been a lag for a lot of buyers. It's been a lag for a lot of deals that you're trying to get over the line, and to be able to get such a fast approval is going to make a very big difference to the marketplace, I believe. And touching on what Ryan said in regards to getting your accountant, your real estate agent, your solicitor and your bank manager in the same room, some of the most successful deals I've seen put together have had all those people in the room. So something to think about, guys. Under your seat there is a business card, is it? And there is a business card under a seat. So if no one's sitting next to you, pinch theirs. Where was it? Is there anyone sitting there? Just a heads up, it's in the third row. When will they be live? That's all right, I'll keep it. That'll be right. Don't forget on the red brochures, there is the QR code to get all of those reports. They are uploaded already, are they?
They're uploaded. Tom?
Tommy? They're already uploaded, ready to go? Yep, good to go. Thank you very much for your attendance, ladies and gentlemen. Grab hold of someone if you need to chat and we'll talk some more from there.